Hey friends, welcome to the channel. In this video, we're going to take a look at what are futures contracts and how to invest in them. You know how to invest in stocks, but for many of you, investing in futures taps into an uncharted territory. It means you could miss big opportunities if you just limit yourself in the stock market. Futures trading draws people in because with little money, you have the opportunity to quadruple your profit. At the same time, people who heard about it decide to distance from it because they heard that it's risky, you should never touch it. Future is nothing but one of the financial instruments you can purchase to gain exposure to various marketplaces, including the stock market. The barrier of entry is a little bit higher than stock, but it's definitely not as high as you think. In this video, I'm going to talk about the major players in futures trading. In other words, you'll get to know who you're up against if you're tentative in trading futures. I'm going to break down all the basics of investing in futures: the contract, long, short, margin, equity, risk management. If you're new to futures, don't let these technical jargons throw you off. By the end of this video, you understand them and get comfortable with each of them. By understanding futures, it opens up a range of new investing opportunities. Now, let's begin with what are futures? 6 out of 10 American adults drink a cup of coffee every day, many of them from Starbucks, Tim Hortons, or McDonald's. These coffee could come from Colombia, Brazil, Peru, and Mexico. Starbucks imports coffee from these countries, processes it, and serves them in Starbucks. Starbucks is a business. It needs to make money. It means by the end of the year, Starbucks is going to want to bring some profit home by selling coffee. That could become a problem when the imported coffee becomes more expensive. Coffee price took two big swings from 1994 to 1999. In 94, it started rising sharply from $70 per 100 pounds to almost $210, nearly tripled in less than a year. Then it falls back to $80 in 1997. Starbucks business should theoretically suffer because the coffee they imported became much more expensive. In reality, the opposite happened. Starbucks had made fixed price purchases for a portion of its supply of green coffee. The increase in coffee price actually made Starbucks more profit. This is the concept of futures. Starbucks in this case is the hedger, one of the crucial players on futures market. Satisfied with today's price, Starbucks can use futures contract to lock in that price for future delivery. In case weather had a negative impact to coffee harvestation, companies like Starbucks wouldn't be affected. They will still get the same price from their supplier. Starbucks could personally negotiate a futures contract with their supplier in Latin America, or they can go to futures exchange where futures contracts are traded. Starbucks could buy futures contract at Chicago Mercantile Exchange. When contract expires, Starbucks will take delivery the amount of coffee at the price written in the contract. This helped them avoid fluctuation in coffee price, thus easier for the company to manage. Just like coffee, you can trade all kinds of everyday commodities on the futures exchange, such as corn, wheat, or cattle. But futures are not limited to agricultural products. Assets like metals, currency, equity, bond, Bitcoin, even interest rate can be written into futures. Starbucks is the hedger in futures trading. But for you probably don't want to take 1 million pounds of coffee delivered to your doorstep. Just like trading the stock market, you're trying to make money by betting on price movement. Futures trading is attractive because of the ability to trade on margin. For example, on some platform, $1,000 gives you $100,000 of buying power. This means trader can control enormous amount of asset value using small amount of capital and potentially making huge profits. On the opposite side, you can also lose large amount of money. So it's extremely important to understand and control risks in futures trading, which I'll show you a simple trick later to help you prevent disasters. As I was saying, trading on margin makes future attractive, but many people distance themselves from futures trading because of the complicated terms. This sometimes makes them pick suboptimal financial instruments other than futures and confine themselves in small segments, such as the stock market. In order to break the barrier, there are only three concepts you need to understand: margin, market value, and equity. Now let's break that barrier. Trading futures is very similar to buying a house. For example, if you want to buy a house that's worth $500,000, you need to make a 20% down payment, which is $100,000. The rest $400,000 is the amount you borrowed from the bank. This $100,000 is the down payment. We can also give it another name, initial margin, meaning only when you have at least $100,000, you're eligible to buy this house. Apparently, the $500,000 is the market value of the house. The equity you have is simply by taking your borrowed money out of the market value, so $500,000 minus $400,000 is $100,000. This is the amount that actually belongs to you if you cash out, namely the equity to you. Now say after 3 years the house is increased in value. The market value of the house is now $550,000. By taking the loan of $400,000 out of the equation, you now have an equity of $150,000. You sold the house, you know you made a profit, but how much return did you generate by selling the house? You bought the house at $500,000. It increased in value by $50,000 by the time you sold it. This makes it 10%, right? Actually, much more than that. Even though the house was worth $500,000, you didn't invest $500,000. You only invested $100,000. The other $400,000 is borrowed from the bank. Your initial investment of $100,000 gives you $50,000 extra cash, which makes it an astounding 50% total return. This is the power of leverage. Of course, it's an oversimplified model. We're not taking into account interest, maintenance costs of the house, etc. But the point is, trading futures is very similar to buying a house. Futures also let you control a huge amount of asset value using small amount of capital. Say you're back in the coffee business. You got information from various business owners and suppliers. You've done your research and are pretty confident that coffee price is going to increase in the coming months. You want to capitalize on this opportunity by long coffee futures. By the way, long means betting on price increase. Short is betting on price falling. Say one futures contract is worth $10,000. The trading platform requires you to deposit at least 20% of the total value of the contract. That makes it $2,000. The $2,000 you deposited is the initial margin we talked about earlier. It's the amount of hard cash you need to pay in order to enter into a position. With $2,000, you are controlling $10,000 worth of assets, which is the market value. By taking out your borrowed money from the equation, your equity is still $2,000. Now say, as you expected, coffee price increased. The market value of your account is now worth $11,000. The equity value now becomes $3,000. Remember, equity belongs to you. If you close your position, you just made $100,000 using $2,000, which gives you a return of 50%. In summary, market value equals equity plus borrowed money. Your borrowed money doesn't change. Equity value rise or fall based on price movement of the futures contract. Leverage can make futures very powerful, but it can also create disasters. What if you were wrong? What if you long the contract but coffee price went down? This brings out the most important part of this video: controlling risk. I have to say the following part might be a little bit dry, but we simply have to understand how to control risk in order not to put ourselves in a dangerous situation. But don't worry about it, I'm going to use a lot of examples and walk you through step by step. If you understand 5th grader math, this part is a piece of cake. Risk is the possibility that reality doesn't meet expectation. To buy a house, you borrow money from the bank. To trade futures, you borrow money from the broker. Naturally, they expect you to return a loan. When future price goes against your will and your account value goes down to a critical threshold, your broker will warn you either to deposit more money or liquidate your position. This is the margin call, and we don't want this to happen. Remember market value and equity we talked about earlier? When the equity in your account falls below a certain percentage of your account's market value, you will receive a margin call. We give this percentage a name, the maintenance margin. Let's use 10% in the following example. Same as before, say you bought coffee futures with $2,000 to control $10,000 worth of asset. The market value of your account is now $10,000. You borrow $8,000 from the broker. The equity belongs to you is $2,000. Now coffee price drops. The margin call will be triggered when market value of your account goes down to $8,888 when equity is $888, 10% of your account's market value. I won't bother you deriving the equation. If you're interested, you can pause the video and take a closer look. It calculates how much market value you need to maintain in your account in order to not to receive a margin call. Now that we know what a margin call is and we don't want it to happen, how do we do it? Now this is the part to pay attention. In order to prevent disasters, you need to give yourself more room for error. Investing is a game of probability. There's a certain percentage you could be wrong. So you need to give yourself room for error based on your confidence level. Let me show you how you can give yourself more room for error in the following example. Let's use the concepts we talked about earlier to illustrate this scenario. Your initial margin is now $2,000, market value is $10,000, equity is $2,000. The required maintenance margin is 10%. To trigger the margin call, your market value can fall as low as $8,888. This gives you a drawback room of 11%, meaning if you lose more than 11%, you're in trouble. But if you buy only $5,000 worth of assets, essentially you only use $1,000 of your deposited cash. Market value of your account is now $5,000, equity is still $2,000, which belongs to you. Instead of borrowing $8,000, you only borrowed $3,000. This gives you a room of 33% before receiving the margin call. You're trading half the profit for more than half the room for drawback. Essentially, you only applied half the leverage as before, in other words, 2.5 times, which is still pretty high depending on the underlying assets. By bringing down the market value of your asset, you control your leverage ratio. If you just bought $2,000 worth of assets, it's like trading your stock brokerage account without any leverage. Of course, there are many nuances and more complicated risk management methods to construct your futures portfolio, but just keep in mind to bring your market value down is more than enough for beginners to prevent disasters. Thank you guys for watching the video. Please don't forget to hit the like button and subscribe to the channel if you're up for more in-depth content for economics and investing. Well, last but not least, best wishes to you, my friend. Hope to see you soon.